you everyone for coming out this evening. This evening we have a rather exciting topic to talk about, market forecasts and what's going on out in the world. Lots of uncertainty going on, so we wanted to touch a little bit about that and how you could prepare yourself for what's to come. So let's start off with a quick market update. So this is the March 2025. This is total residential price, so across all property types. I'll just highlight the main things, which is you'll notice sold listings are going down, so sales volumes are dropping year over year. And you'll see a similar trend in the other aspects, months of inventory, average days on market, and benchmark sales price, which are all going up, okay? And you notice months of inventory is quite a bit higher than where it was last year. And this is a consistent trend that you will notice. So here on the left, if you're looking at the screen, is detached. On the right is semi-detached. Year over year benchmark sales prices are still higher than where they were last year this time. However, again, if you look at months of inventory, we're almost 120% for the detached and roughly 170% for the semi-detached. However, lots of inventory, but they're not selling. It's taking a lot longer to sell. However, what we're noticing is prices haven't really dropped yet. We're seeing a few price decreases, but for the most part, they're holding fairly steady at this point in time, right? So we'll have to see how that plays out, but there is a good chance prices might start to come down. Next slide. On the left, row house and apartments. Row house on the left, apartments on the right. Interesting one is the apartments. Almost a 200% increase in inventory. Key thing to note, we expect the months of inventory to keep going up for the apartment sector just because of how much supply is currently under construction, lots of purpose-built rentals and condos under construction right now, and all these have a rather long cycle before they hit the market, typically anywhere from 1 up to 5 years, depending on how big the projects are. So tariffs, I'm sure everyone's been following the news. Everyone's probably concerned to some degree of how tariffs will affect us. For the most part, Canada has gotten pretty lucky with tariffs. We've not been hit as hard as some other countries. However, we still have tariffs on steel and aluminum. The auto sector is still being affected, which will have a trickle effect on Alberta's economy as well. On top of that, we have essentially a double whammy. China has also put tariffs on our canola oil, seafood exports, meat products, and stuff like that. Okay. Bank of Canada released a business outlook survey a couple of days ago. On that survey, I believe it was 500 of the largest firms were interviewed. Roughly about 32% of them are predicting a recession in the upcoming year. Okay, and this is up from 15%, which was what they had polled over the past 2 quarters. So what's going to happen if tariffs continue to stay in place? We're likely going to have inflation. Okay, tariffs are going to drive the cost of everything up, and inflation is good if you're an asset owner. Don't own assets, it might hit you harder than some others. Okay. On the left here is a chart from the ATBL. For those who don't read the ATBL, it's actually a really good resource to kind of stay up to date on what's going on in Alberta. We're somewhere in the base case scenario right now with tariffs right now. So effects of tariffs. So the chart on the left is from the Business Outlook survey that was published by Bank of Canada, which essentially shows you the direction of pressure that will happen with the various influences. Okay, so input costs and selling prices are going to go up. Like I said, it's going to cause inflation. Prices will go up. As a result, on the right-hand side of that chart, you can see sales in Canada are either already lower or are expected to be even lower in the coming months ahead. Okay, and likewise, monthly unemployment is starting to trend up. We had a run up. Unemployment was improving in the last 2 quarters of 2024. However, unemployment is starting to go back up again. Okay, we are slightly higher than the national unemployment rate. Not a ton, but still. So locally, what's going on? I'm sure as a real estate investor, if you own properties, if you're trying to re-rent your properties right now, you would have noticed that it's taking either a lot longer or you're having to drop rents to get your places filled. So this is a chart that I pulled from rentfaster.ca, and it's month over month data, and you can see the up-down trends. Essentially, for the most part, in most sectors or property types, whether it's townhouse, apartments, main floors, basement suites, rents are going down month over month. And one of the main reasons for that is increasing supply. Tons of purpose-built rentals being built all around the city. Lots of suburb properties in the new communities all come with basement suites as well. And those properties in the new communities or the suburbs, take for example Redstone. Okay, it's an example. That's a community with lots of basement suites in the new construction houses. Rents have come down significantly more than other parts of the city for those basement suites because there's so much supply in that area, right? But that's essentially the general trend is rents are coming down from the peak that we had last year. Okay. The effect of that is a lot of investors who bought at the peak thinking that rents were going to remain that way have now decided to either cash out or just call it quits and sell, right? Which is also leading to increased supply on the market rental properties. A good example, I actually wanted to bring this up, is in Huntington Hills. I was just looking today. We have 16 detached properties for sale right now, whereas just the same time last year, it was, if I had to guess, it was probably around 4 at most, okay? Out of those 16, interestingly, 8 of them are actually suited properties, so they're investment type properties with basement suites, okay? That shows you kind of where things are moving on the investment side. Okay. So yeah, the second bullet point, rental completions are up 160%. That's data from Build Calgary. Okay. So how can you be prepared as a real estate investor for what's to come? If you're planning on selling, if you already planned on selling, things you have to do right now in the market, you have to be priced very competitively right off the bat. So the days of pricing higher and hoping to do price drops, they're less effective now because essentially what you're going to end up doing is chase the market down. And you'll become a stale listing sooner than later, okay? Which is what you want to avoid. Expect to be competing against other similar listings in your area, which again drives home the bullet point number 1, being priced competitively. Okay? If you're planning on buying, and it's not a bad time to buy right now because you have a lot more negotiating power right now, but make sure you're conservative when you run your numbers, right? Often with tenant occupied properties, say if they're getting $2,000 a month for the main floor, make sure you're accounting for today's rents, which might be $1,800 or $1,700. Okay, so yeah, account for decreasing rents and rising costs. Especially insurance has gone up quite a bit in Alberta. If you've bought a new property recently, you will notice that your insurance is quite a bit higher. Or if you have a renewal coming up, like I had a renewal TD, and the insurance was almost double, and that was an existing property. Right? And they claimed it was because of all the hail damage going on. So, but if you shop around, you can still find a good rate. Okay? If you're buying a commercial property, so something with MLI Select, for those who are familiar with that, 5+ units, and you have a long closing, so at least 6 months are out, make sure you have a reserve fund, because if you're not able to meet the underwritten rents that CMHC used when you applied for funding, and rents, say, are now 15% lower than what CMHC had underwrote, your loan to value is going to get readjusted. So CMHC is going to either ask you to put a higher down payment or pre-lease the units to show that you can actually achieve those rents, which might be challenging. So if you can't close or you can't top up the down payment, then you might be in trouble, right? So plan ahead for that. Last point is new construction properties in the suburbs. This is a good time to buy a primary residence if you want to buy in the suburbs, or if you want to buy a semi-detached or detached with a legal suite in the suburbs, because you can get pretty good negotiating power right now, okay? Even with builders, I'm not gonna mention which builder, but a couple of weeks ago, I was talking to a builder representative. Just talking with her on the phone, I got a $30K discount off the price, off the posted website price, okay? So that gives you an idea of how willing builders are right now to negotiate. So I'll hand it over to Layne Walters.
Okay, well, thanks for the rosy news. Although I think most people in this room are aware that the market has certainly shifted, and that's the nature of any kind of market. When this is, I think, my third cycle. 2005, I bought my first property, so things peaked right after that, and then back down, and then peaked 12, 13, 14, and then back down. So this will be kind of the third cycle I've been through, and as a mortgage broker, so not only am I an active investor and have been the entire way through, I have a lot of clients that are investors, but everyone that flips houses, that build, and then of course buy and hold. Buy and hold investors always last because over the long term they continue to build wealth. Flippers rarely last because eventually the market catches them, they lose money, and it's hard work. You do the work, you get paid once, and then you pay your taxes on that. Whereas when you buy and hold, that every kind of up cycle you get the benefit of it, and in a down cycle you don't feel it because you're just collecting rents. So I've certainly seen this a lot, over the long term. But one of the things that I like to talk about in terms of long-term real estate, which is the only way I invest. I don't think you should, if your time horizon in real estate is less than then I'd say 3 years, even 5 years, in my opinion, you shouldn't invest if you're trying to invest for 5 years, because it's too short of a cycle. You could end up in a downturn where the market doesn't do anything for you. So anything 5+ years is real estate investing. Anything less than 5 years, in my opinion, I would consider it speculating. Even if you're buying condo pre-sale, stuff like that in major cities, people are getting crushed on those right now. And if you're flipping houses, I don't even consider that real estate investing. It's a business and it involves real estate, but it's not real estate investing. It's more construction than it is real estate investing.
That's active income, right?
Yeah, it's active income, and it's taxed as such as well. And you have to remain active in it. It's not passive. So, and a lot of people that did flip, it used to be 50-50. I'm pretty good at talking people into the longer term stuff, or saying flip properties if you are, but make sure that when you're flipping a property, that it is a property that if the market turns on you, you're able to hold as a long-term investment as well, and it's going to cash flow or be reasonable in terms of its month over month cash flow or expense, so that you can hold it for a long-term investment as well. So inflation is good for real estate. I added to that eventually because inflation isn't linear. It doesn't go up all at the same time. So the reason why inflation is good is because you use debt to purchase it. And what happens, with inflation, everything goes up in value. It's numerical value, right? So the gas goes up in prices, groceries, wages. So if everything doubles and minimum wage is $30, I mean, it was $7 not too long ago, now it's $15. Well, it's going to be up at $30. Houses are going to be $1 million a house in Calgary at some point. Gasoline's going to cost twice as much. A jug of milk's going to cost $14. So your house has gone up in value, in price, but is it really any more valuable? If you sell it, you can't buy more jugs of milk because everything's gone up in price, right? So then, why do we want real estate, and why would we want inflation in real estate? And the reason why is because the one thing that does not go up is debt. So if you buy a house at $500,000 and it goes up to $1 million, and everything else, wages, everything else goes up too. Everything goes up except your debt. Your debt still stays at 500, which essentially would be, in today's dollars, 250. So what actually happens is the value of the asset goes up. It doesn't actually go up. It stays with inflation, but the value of the debt that you purchased it with actually goes down. And the reason why that's kind of an important distinction, because we could easily just call it appreciation, and the numbers work out because your debt doesn't go up. You just tack on appreciation to the value, but not the debt, and it's an easy way to calculate it, and that's actually the simplest way to calculate it, and it's accurate. The reason why I like to point out that it's actually inflation devaluing debt versus the actual increasing of value of the asset, the reason I like to point that out is because we know that inflation is coming, because the same reason we want our debts paid off, the government wants their debts paid off too. So what we know is that governments love inflation, right? They don't like to admit they like inflation, but the government spend too much money. If they cut every service in half in the country right now, shut down every second hospital, laid off every second nurse and doctor, it would still take them decades to pay off the debt that we have. If we increase taxes, it would crush the economy, and then taxes wouldn't actually increase at all. So those are the ways a country can pay off debt. They can either cut their services, or they can increase taxes, or the other way is to inflate it away, which is the option that all governments ever have always chosen right up until their economies eventually collapse, even if it takes 500 years. That's essentially what governments do. So the government wanted inflation. They tried to deny inflation was happening. Then they said it was transitory. Then they blamed Vladimir Putin for it. Now they have a new villain that they're going to blame on this new inflation. They're going to create inflation because it'll pay off their debt, but they can still print more money, hand it out to everybody to buy votes, and to give their investment banking buddies lots of money, because banks have made a lot of money. Investment banks are all richer. We've seen it. The stat, everyone's probably seen it by now, that the largest transfer of wealth to the poor and middle class to the mega rich has happened over the last 4 or 5 years, like in Western economies, or at least in North American Western economy. So inflation is something that the government kind of wants to continue because it helps them meet their agenda. So if you have $100 million and you can play in the bond market, you can also make a lot of money doing this, or if you're a major investment bank, you can make money doing this. But most of us here don't. So the other way for us to do it is with real estate, because we buy an asset that's relatively stable, and we buy it with 5-to-1 leverage or 4-to-1 leverage. So you can buy an asset with the same type of leverage, and it's relatively stable. So, and then what happens is, as the government tries to pay off their debt, they're paying off your debt too. I'm not saying this is what should happen. It isn't the most efficient way to run an economy, but it is what will happen. The government will continue to do it, even if the Conservatives win the next election. They still have to print money too. There is no other way out of this. You cannot cut 10% of the workforce or 10% out of the government budgets and not expect, blood in the streets. So we're going to deal with inflation, and now they have a villain. They can say, well, it's Trump's fault. It's not our fault. We didn't mismanage anything. We didn't overvalue, create a kind of a circumstance where real estate's overvalued across the country, especially in Southern Ontario and the GTA specifically. It wasn't our fault, it was Trump. That's when everything went bad. So they're just going to use that as their excuse, but really they're going to print their way out of it. The economy in the GTA in Southern Ontario has been built on the ability to leverage real estate. The governments get their money not from paying property taxes, but charging development fees. So it started at $10,000 a unit, then 20, then 30, now it's up to 200 plus land transfer taxes municipally, land transfer taxes provincially. So you're looking at $250,000 out of the $850,000 condo price. That's only a 300 square foot, 1-bedroom condo on top of it. So then they created those costs, just adding, ever increasing those costs to cover their own, city expenses. But then they put a green belt around the city to restrict building, which is a fake barrier to increase the value. If we look back in the early 2000s, so you look up these stats, Calgary and Toronto were always going back and forth, what was the second most expensive city in the country. So Vancouver's expensive, and it always will be. It's always excessive because they have no land. It's a beautiful city, and they have no land. There's water and there's mountains actually in the way. In Toronto, they're like, well, we'll just make this line, call it a green belt, and nobody can build here. And it just made land really expensive, but it was false. So Calgary and Edmonton were even. And then from 2007 to 2022, Calgary's prices were exactly zero. So it was about the middle of 2022 that we actually matched the peak of 2007 prices. In that same time period, Toronto tripled, so a 300% increase in their prices. But their incomes didn't go up faster than ours. So the math doesn't work. It only works because they continued to boost up the value by restricting and charging a lot of taxes. And the only way that people could afford that is because interest rates were coming down, and 5% was a very, very low interest rate. When I got my license in about 2005 as well, and there was a little book that came with it to do amortization tables. That's how kind of old the system was. And it started at 7 because rates just hadn't been below that for 20 years. So now so the rates continued to go down, and then it was exacerbated during COVID to in the 1%. Well, now those people are turning their rates over into the 4s, maybe the 3s if they're lucky, and those interest rates are going to really hurt their economy. So $2,000 per month is going to be taken away from the largest consumer spenders. So GDP is 2/3 consumer spending in Canada. That's pretty normal for a Western economy. But in the GTA, that's been the bulk of their industry because those prices have been going up. That money is essentially made up from thin air because a young couple, 4 months on their first jobs, haven't saved anything, inherit enough money to put a down payment down, and they could buy a $900,000 house with a $900,000 mortgage essentially. And they create $900,000 worth of economic activity. So that money gets dispersed through salespeople, engineers, and then it goes to the restaurant owners and the stockbrokers and the framers, and they're all buying cars. And then the car salespeople are eating out at restaurants and putting their kids in hockey and buying cars. And that money kind of accelerates to the economy because it's made on the top level. It's made out of thin air. But unlike, say, when we sell a barrel of oil in Alberta, that money does the same thing. It cycles through our economy. But we've sold the oil, we traded something for it, so the transaction is complete. In Ontario, if it's just built off house prices and you borrowed the money, you have to pay it back someday. And with interest rates tripling, now we have to pay it back. So that is going to unwind their economy to a point that's going to be very difficult for Ontario to accept. And then added on top of that, we're getting these tariffs. And even if everything goes away and it goes back to normal and there's no new tariffs, the message that has been sent to anyone, if you're going to manufacture and you have planned on selling anything in the United States, it better be manufactured here. So you think if Ford was in, or Stellantis, or any of the big major auto parts, or any manufacturing of anything, if they were debating, okay, should we go in Oshawa or Windsor, or should we put it in Philadelphia or Detroit or Michigan somewhere? Do you think anyone will consider Canada right now? They're like, no, message heard. Whether it happens now or in 5 years or 10 years, we're not going to take that chance. All of their money is going to be going to the US. So Ontario is going to have it rough. But that means that interest rates are going to stay low, even for us, even if we don't need it. Not only do I think interest rates are going to remain low on the variable side, in spite of possible inflationary impacts of tariffs, I think they're going to participate in the bond market and lower fixed rates with quantitative easing as well. Tariffs are inflationary. They're going to drive up the cost of everything we buy. I do also think that the government will still get away with just higher inflation numbers, and the government just changes the calculation for inflation. I mean, when we have 2% inflation, according to the government, it's really 4.5%. They just adjust the formula that they're using, and they're constantly doing that. They don't even deny that they're doing that. But one of the things that's happening is rents are coming down across the country, including here, and mortgage costs are coming down compared to year-over-year numbers. So everything is coming down. That makes up about, housing costs make up about a third of the basket. So in spite of the fact that we may be paying more at the grocery store or when we're buying stuff at Walmart, we are going to see some downward inflationary pressure for housing costs at the same time to offset those other costs. So inflation may actually appear lower in some ways than others. So again, this is a very kind of a long conversation that inflation is good for real estate because you buy an asset with borrowed money, and then the government, not because they like you, but because they need to pay off their own debt, they're going to devalue that debt because they need to devalue their own debt too. So that's the real secret in real estate. Now, why I'm comfortable with real estate, but again, it doesn't happen linear. Just because grocery store prices go up doesn't mean rents are going to go up. And if you look at what the next slide actually shows is something, well, if you told someone in 2023 that don't worry, wages go up with inflation, they'd be like, yeah, sorry, not my wages went up 2% or 2.5%. They sure is, they sure didn't go up as much as the grocery store prices. They weren't 10% or 12% or 25%. But if you look what happened today or last week, the Alberta Nurses Union just reached, that's a 20% pay increase for nurses. That's a pretty big deal. That's across the country, making us more competitive. But at the same time, that's over a 4-year period. That's a 20% increase in pay. That's a big chunk. So, and I don't think inflation is going up at that. Like, we're not going to see inflation over the next few years at 10% in rents and all the other stuff. But again, the rent inflation already happened a few years ago. So inflation, it kind of goes up in a band. It's always going to accelerate up, and depending on what the government does, it's going to increase, but it doesn't happen all at the same time, which is why we have to be pretty careful about it, because rents aren't necessarily going to go up. And we were fortunate in Alberta when interest rates went up, our rents went up too. But there were places like Toronto where they were having their prices and their rents started going down while interest rates were still going up and high. So yeah, eventually, wages increase the capacity to pay higher rents, pay a higher price for housing. Now that 20% has been announced by a public sector union, do you think the city of Calgary is going to be okay with the 12%? That's now the starting point for every public sector union across the province and maybe the country, just to say, hey, 20% for nurses, why don't we deserve that? So of course, the city is going to have to pay that to all their employees. They're going to have more money. And of course, they're going to have to increase development fees, which will increase the value of real estate and the cost of real estate. And then of course, if there are tariffs, we're going to be importing all the stuff that's manufactured overseas, everything from our lighting to our cabinets, all of that's going to increase the price as well. So it's going to kind of support the bottom end of prices. Again, we have supply and demand dynamics that are going to impact us negatively as well. So we're already seeing rents go down, I'd say 10 to 15%. by the summer. I think it's going to be 20. It's going to stay there. I'd say we're 12 to 18 months away from the nadir of our market, so where we're going to hit the bottom. And so I think that's why I feel be prepared for it. But again, real estate's long term. If you own a property, if you bought a property 25 years ago for $110,000, it's now worth $600, and the mortgage is now paid off, or you've refinanced it, but you've made money the entire time. Would you care that you lost $2,400 for 2 of those years, right? And that's what I would say. Don't panic and sell now, as long as you can handle eating a $200 negative cash flow. You still have principal pay down. You're still actually profiting. It's just negative cash flow, which you do have to be prepared for. But from a long-term perspective, you can trust that real estate eventually is going to go up with inflation. I would say the supply-demand dynamics is, and what Anthony was alluding to, is with a lot of what's been built is like rents went up, so people build more houses, right? That's what a free market is supposed to do. Alberta doesn't have rent control and things that get in the way. But what happened is they designed a CMHC program called MLI Select, which I'm sure most of you are familiar with, but it's 50-year amortization, now up to 55, and 95% financing. Well, that's absurd. 65% financing is where banks, if CMHC is not backing them, banks will lend you usually around 65 for a multifamily residential, maybe up to 70. So, but all of a sudden this, the government gets involved, says we'll guarantee everything and we'll go to 95. And because the cash flow wouldn't make sense at that, we'll give you a 50-year amortization, which is basically zero pay down. Like there's very, very little of your mortgage payment going to actually pay anything down. Now that program was designed with affordability in mind, so you have to keep a certain amount of your units affordable. Well, in Alberta, our affordability was so good already that you didn't have to drop rent. We were already below that because we didn't have the same problem that all the regulations and restrictions in Toronto and Vancouver caused. So the program was designed for them, but it worked so well here that everybody started doing it. Jim, I think it is, he had construction, all of his, he's a builder, does single family townhouses, and all the people he knows are now they were all of a sudden professional landlords because they could overcharge themselves and then they overcharge themselves in terms of what they build, but then they themselves are the buyer on the end, so they're okay being overcharged, and they put that into the financing. I'm going to pay it back over 55 years. So they were able to upfront take the profit out. The problem with that, it was so successful, too many people did it. Builders from across the country. I have a colleague in Winnipeg, he's like, yeah, Bill, all my builder contacts, my medium-sized builders, left and went to Alberta to start doing these MLI Select products because you could make so much money there. And it's so easy to build. And we were looking at our own project and looked at the numbers, and that scared me so much that I'm like, I don't want to be involved in when this thing collapses because it is a finance-driven market. So people weren't doing this, like building these because the market dynamics of the rent were supporting it. They were doing it because of the financing. They made money at the end of the financing period before they collected a nickel of rent. They could add in $500,000, pocket that, and then move on to the next project because they were the builder and the end user. And then of course, end users, a lot of new investors have gotten involved in that as well. So are these projects good long-term? Absolutely, everything is, but that's what's causing what I would consider a long-term problem, the 12 to 18 months, that's what's causing our rents to crash right now, is all of those units are now hitting our market and they're driving rents on. I mean, how many 500 square foot, 1-bedroom basement suites do we really need? Especially the suburbs where a lot of these were built. You might have a handful of people that want to live out in the middle of nowhere because they happen to work there. But so you might be able to support 5-10 basement suites in a neighborhood up in the middle of nowhere in Sage Hill or way down south in Legacy. But hundreds of people living in basement suites in the middle of nowhere where there is no room for parking. There's no requirement for parking. There's no room because the driveways take up there's no street parking, no requirement for parking, and there's no transit. So unless you work there, how are you gonna get anywhere? Where will you park? So not great units. And then the problem also is that now that a lot of people can see the numbers aren't working as well, they're going to stop going after these. This was like 2 years ago. You guys could not hang on to. Everyone was calling. Do you have any lots that we could build eightplex? Do you have any lots we could build eightplexes on?
Yeah.
And now what's happening? What are the calls now?
Now we got lots.
Yeah.
Lots
now
of
it's people calling saying, I have a bunch of these lots.
Yeah.
Can you find any buyer?
Yeah.
And part of the problem is, even though those numbers have been obvious to most investors as they go through it and actually sit down, plus CMHC changed the rules where you have to pre-sell or pre-rent units, but you can't pre-rent from 2 years from now. So you have to cough up 25%, and then only once you rent at the high rents can you actually get the rest of the 95% financing. So the numbers kind of have stopped working at those peak prices with the current rents. But once you've torn the house down, you've got to finish it out. Once you're in construction and you're building out your framing, if you look, the numbers don't work because rent has dropped, well, too bad. You still have to finish it out. There's no kind of halfway. You can't just put it on pause. So unless you already have, like I'm lucky, the project that we stopped, we have 3 houses right next door to each other and they all cash flow. So they're just the houses with basement suites. We'll just wait until the next run, and we'll do it then. But in the meantime, we're not forced to do anything. But had we torn those houses down, which next door to us they've torn the houses down. Now they have to finish out, even though the numbers don't make any sense. So that's why I'd say 12 to 18 months, because anywhere from 10 to 12 months to build, 18 maybe, depending on who's doing it. So we're going to see some of this inventory continue to hit the market. I'd say by the third or fourth quarter of this year, we're going to see a slowdown in housing starts. The only reason it hasn't slowed down yet is because people have torn the house down. They've put a bunch of money in, they're financing it at probably private money costs, and now they have to exit. So they have to finish the project out, even though the numbers don't work as well.
Yeah, and lots of infill builders, like from what we're seeing out in the market, they've already pulled back on these projects. So those who've purchased lots with existing homes, they're either trying to sell off those lots or they're trying to get a buyer before they even start building, because they're realizing they're not going to be able to get those same prices anymore. So they're essentially stalling the projects right now, right? So whatever is being built right now or already started will get done, but the number of new projects that are starting right now it's quite low. Because rents have come down, so essentially the financing is no longer going to be as favorable anymore. So the end sale price is coming down as well, right? And if the end sale price comes down, the builder's profit goes down, so they're less incentivized to start building. So,
yeah, which essentially is what a market's supposed to do. It's just this created probably a little bit of a glut. This program, because it was designed for elsewhere but still applied here, probably created a glut that's going to take us 12 to 18 months to get through. Toronto, they have a 15-year speculation problem to deal with. People are taking possession of condos that they purchased for $900, and they're appraising out at $700. And sometimes they have multiple of those units, and like 10% of that stock has hit the market. So as more and more hits the market, rents are going to crash, and they're already way below what it would take to finance them. And then the prices are going to crash. So the banks are supporting it by doing blanket appraisals and just still giving people the financing, even though it might be 100% over current loan to value rules, like current appraised value. They're okay with that because it was like, well, it's either this or the whole building. We finance the building, and if we don't just give these individuals mortgages, we're going to get stuck with this building. And what are we going to do with it? It's worthless. Like it's a bad building based on the numbers. So they've got 15 years to deal with. We're going to have 12 to 18 months to deal with, and we still have the strong economy. So we've done a lot of stuff in the past little while, and last year we did a few, I think earlier, maybe January, we had part of it, is a lot of our new employment growth, none of it was oil and gas. Oil and gas are still our biggest industry and revenue generator for us, and certainly for the government, but our job growth, 100,000 plus, kind of a really strong job growth the last few years, is all private sector. Most of it was not oil and gas. CapEx and oil and gas stayed pretty stagnant from 2019 to 2023. Last year it picked up, but with Trans Mountain being done, there's capacity, so there's a handful of things that are driving the economy to do well here. So now, this is population growth last year. This is the net migration per province. So we had the Yukon and Nunavut, we lost a few people to. Outside of that, this is the net migration from other provinces. This is the smallest part of population growth, by the way. We've births versus death because we have the youngest province. We have far more births than we do deaths. So we have a kind of a growing population there. And immigration, while it's being cut back in other provinces in terms of the amount of student visas they're allowed to give, in Alberta, we didn't have any of those fake schools that were running on pretend student visas. We just have our university. So Alberta's been allotted a 30% increase in our international students, while most of the other provinces have been told they can't do it. So we're going to get a lot of the international migration, as well as people are continuing to come here for work. I know we had a bad month last month, which is pretty volatile. The end quarter of last year was like record breaking in terms of job creation. So I still think that's strong. We have the highest unemployment rate. I know Santhosh's slides showed that. But Alberta's unique because we have a very high labor participation rate. So we quite often have the highest unemployment rate and the highest employment rate at the same time. And the reason why that's possible is if you're not looking for work or you're not in the workforce, you just don't get counted. So we have a higher percentage of our population that's working. But if you go to Quebec or Ontario, less people are even trying to work. So it's like they don't exist. So they don't have as high unemployment, because unemployment only counts if you're looking for work. But we have a higher percentage of our population that is working. And people move here to work. People don't move to Alberta because it sounds like a really cool place to spend winters. And so this is a lot about it. We've basically been ignoring oil for like the last year and a half, every economic update we talk about, but it's like, it is an underlying fundamental, but we make money on the production of oil now in terms of our tax revenue, not the expansion of the production of oil, but that's starting to change. So what's happening with these tariffs and threats are actually, I think, going to be good for Alberta. So we predicted in January that like oil and gas tariffs are not going to happen. There's no way he'll do it. And we kind of got lucky because he threatened 10% that he was going to do that. And I suggested that they might come into place for a very short period of time as a negotiation tactic. Luckily, we didn't even see that. But the two reasons was he needs to keep gas prices low. The way where our product goes is to the Midwest and gets refined into gasoline there. Parts of it get refined into gasoline there. Those are the swing states. So those are the states that he used to be Democratic states that Trump has just won over. And that's where the gas prices would double if tariffs went into place on our oil and gas. There's no way he was going to let that happen for any length of time. And also, it's going to keep gas, like everything he does with tariffs is inflationary. He's going to force manufacturing here where it's more expensive, or in North America or US where it's more expensive compared to Vietnam or Southeast Asia. So lower gas prices will help offset the cost of almost everything. The other one is they make billions of dollars off us. They buy our oil at Western Canadian select prices, which is way cheaper. They take it and then they sell it on the world markets for the real value of it, because we only sell to them. So they want our oil. It would be a big net loss to them to not buy our oil and then upsell it for basically free. They do refine it, but anybody could refine it. We could ship it as raw bitumen to China and they'll refine it too. They've always gotten away with that. That has changed because, I'm gonna scale back. So Trump said, we've heard him say he doesn't need Alberta. In the same day he would tweet, we don't need Canada's manufacturing, we don't need their oil and gas. The same day. By the way, Keystone is pre-approved. Anyone who wants to build it, I will bring the military to get regulation approved. Like he's like, it's pre-approved. Whoever wants to build it, it's done. Just somebody just build it. We want the oil. But by the way, we don't need the oil. We don't even want it. But we need it. Can somebody build it? Like it's just a hilarious dynamic that he would say that. But clearly they want it because they make so much money off of it. And their entire infrastructure is set up to refine our heavy oil. All the new oil they have, the fracking that they've developed, is all light sweet crude. They have no refining capacity for it. They ship that off and sell it, and then they take our oil and they refine it for themselves. They also need heavy oil for other things like asphalt and plastic. There's other things that heavy oil is used for, including shingles on houses and roads. But they are just set up refining for it, and that would cost hundreds of billions of dollars for them to change that infrastructure over. So why bother when they can just take our oil? So we've got competition. There are other places in the world that have heavy oil as well. One of them is Iran, and the other one's Venezuela, who is shipping all of their prisoners into the United States through Mexico and causing chaos there. So this is a couple of weeks ago. Trump put tariffs not just on Venezuelan oil. They don't buy any of it. Any country that even buys oil from Venezuela is going to be tariffed at a full 25% for anything they sell into the US. So our competition is Venezuela, clearly not friendly, like they don't want their oil. Not to mention, even if regime changed in Venezuela, they got a government in that was US friendly. Infrastructure for oil and gas, as we know, is very, very expensive and takes a long time to pay back. It's like 15, 20 years to pay it back. Administration lasts 4, maybe 8 years until they vote in a socialist government who's gonna go in and kick out all the oil majors again, like they did last time. They're gonna be a little hesitant to go in when they can just get oil from Canada by investing here. So it's like we're the only people in our way of investing in our oil is the rest of Canada, which of course is changing because of our friend Donald Trump has now got people like, this is what Albertans have been saying forever. We need more pipelines to sell world market prices. The rest of the country is saying, no, we don't need pipelines. Now they're losing their own jobs. And now they're thinking, okay, wait a second. If we could sell, Trump wouldn't even mention this trade deficit, because if we had the option to sell to Europe and Asia instead of the United States, even just cut our oil by 1 million, 2 million barrels a day and sell it elsewhere, that would be devastating to their economy, but it would very quickly fix our trade deficit with them. So our trade deficit is only in oil, which is a raw commodity that they can get. He can force manufacturing into the US. You can't take all of our infrastructure in Fort McMurray and put it in the middle of Nevada. Even if you could magically do that somehow, that's not where the oil is. So they have to get it from us. But again, the rest of the world wants it too. And we also have LNG. Here's the spread, just Trans Mountain. So it still makes up, I think, somewhere between 15% of our export capacity, most of the rest going to the United States. And incidentally, it's California that buys the majority of our oil that goes through Trans Mountain, but we could sell it elsewhere. So if you look at the spread from in January of 2023, before Trans Mountain was pumping oil, about $25, now it's down to around $12. It's not that we're getting better prices for the extra that we're shipping out of the Trans Mountain. We're getting better prices on all of the rest of the oil, even the stuff we're selling to the US. So this is a big difference for us. So even as oil prices come down, the spread isn't as big. West Texas Intermediate goes down, okay, but we're getting $12 more compared to what we were, not to mention, because of the rest of Canada, our dollars so bad, and we get paid in US dollars. So Alberta gets paid in US dollars and there's less of a spread. So even though oil prices have coming down, we're still in far better shape than we've been any time in the last, prior to the last 3 or 4 years, any time in the prior, half a dozen years before that. So we're in pretty good economic shape, not to mention the other industries that we've brought here as well. This is I like this stat because it takes between 3 and 4 private sector jobs to support one public sector job. So what's been happening in the rest of the country is they're just borrowing money instead, and they're creating public sector jobs. So the rest of the country last year created 1.4% increase in private sector jobs, but somehow increased 5% of public sector jobs. So they're growing an already overweighted public sector even more overweighted. But if you look at Alberta, it's the opposite, where we had 6.5% increase in our private sector jobs and only had 3% increase. It should be 1-to-1. It should be 3 and 3 or 4 and 4 or 2 and 2, whatever it is, if you want to keep the ratio the same. So we're increasing 6.5. Like, it's not just half, it's actually more than that. So we've got what I would consider a lot of dry powder compared to everywhere else in the country. So if we need to build, certainly we can support more public sector jobs. I'm not suggesting that we need more, but if we want to build a green line or high-speed rail, this is the time to do it. And Danielle Smith on our radio talk show was always like, government should spend money in the downturns, because not only do you help people stay employed, that's when it's cheaper to build the infrastructure that we need. We always end up not employing people and building it because we don't have money. And then when the economy booms, that's when we try to build everything and it costs way too much. So she's an advocate for that. So even if our economy does start to suffer for whatever reason, I think she'd be willing to then push forward on infrastructure projects, if only to get them built for cheaper. So this is, I don't know if the lighting in this screen, if you can see there's 2 different colors there. This is basically the debt as compared to our economy. So our 42%, we have debt that's basically 42% of our annual GDP in Alberta. So obviously we're lower than everywhere. But if you look really closely, I don't know if you can see it, I can just barely see it here, but this is all the Canadian, the darker color in the bottom is all our share of the Canadian debt compared to our economy. This is Alberta's debt. And this is where Ontario's starts. So if we doubled our debt, we would still be under half of what Ontario's GDP would be as compared to their economy. We would still be under what BC is. Only Saskatchewan is in the same boat in terms of economy compared to debt. So again, we could quadruple our debt, probably still be below what Ontario's debt is as compared to their GDP. So we've just got a lot of dry powder. We've been, part of what's good about our up and down economy is that we always have a time to go, okay, wait a second, we're spending too much money. In Ontario, they keep supporting and propping up their economy so they never have something to say, wait a second, these real estate prices are crazy. Wait a second, this spending is crazy. We have that every now and again, so that keeps us from being excessive with our spending, and we're lucky with oil. So yeah, the long and the short of it is, am I still buying? So because I buy real estate for long term, I'm buying. I wrote it off for a couple of weeks ago, or closing on at the end of this month, because it's a good house. So I don't care whether I time the market perfectly, because my worst timed purchase is also my best property. I wish I had overpaid for all of my properties, but they were identical to that one. So it's like a year or two ago, over the last few years, it's been really hard to buy a property. You see a property with a basement suite, it's legal. Yeah, get in line. There's 15 other offers. You can't, no home inspection, no conditions. And it's just really hard to actually buy anything. Whereas in downturns, I managed to find even competing offers in downturns because I have a specific type of property that I like in terms of good cash flow, good location, easy to rent long term. I also like to buy bigger lots with room for future potential development in an expanding economy. But yeah, everything I do, it's like, I don't care about what happens for a 2 or 3 year period. What I care about is building a really good portfolio of really good properties. So, and over the long term, my successful investors, in fact, it's a weird dynamic right now. All of my investors for the last few years have been new, young investors, which is great, but they're pretty quiet right now. And all of the ones that are buying, I have like 9 offers in the last 2 weeks. Less than 2 weeks, since last Monday. All of them are my investors that own 4 or 5 properties and have been buying for 15 years. That haven't been active in the last few years, but now they're like, yeah, I found a property, I think I'm gonna buy it. And it's just this dynamic of okay, they want to do a home inspection, they want to be able to negotiate, they don't like jumping in, they don't like competing offers, but it's all those people who are now kind of reactive in the market again. So it's so I feel like I'm not the only one saying, yeah, I still like buying. It's the more experienced investors are kind of buying right now too. There's a caveat on that, you gotta be careful. Your cash flow, if it's currently rented and you're buying a property right now and it's got $1,600, $1,700 in the basement suite and $25 upstairs plus the garage, you're not gonna re-rent it for that. And when it comes up, when those leases come up in August, those are gonna be a lot less. So you need to be prepared for the small kind of vicissitudes of the market. But if you're buying for, 5, hopefully 10 plus years, then just focus on buying a good property. Whether you find one in 6 weeks or you find one in 6 months or 9 months, just focus on buying a good property. That's certainly what I'm doing. I didn't want to buy this property, but it came up and it's like, this one's a good one. I can't say no to this, it's too good, which is frustrating my wife, but it's a good property, so I bought it basically. So the long and short of it is, speculation, flipping, a little more risk to it unless you're a professional and you really know what you're doing. It's again a different business. I don't do it. I have only flipped one property and I've bought 25 plus properties over the years, and I still have 17 or 18 maybe now once I close at the end of this month. So yeah, long term, inflation is good, and inflation is coming because the government wants inflation. They have to pay off their debt. They cannot handle deflation. They cannot handle the stock market crashing. They can't handle real estate in Toronto crashing. So we're going to see inflation. It's ultimately good for real estate, even though it may not be in the short term. So just be prepared for managing some negative cash flow for a year of a couple $100 per property or per, look at your numbers. ask around about rent, look on Rent Faster, see what things are renting for, not what the lease currently is, because that might be from 2 years ago or last summer. So be prepared for that, but otherwise, still a good time to buy. And I think that's about it. So
that's essentially it. So.
Yeah, so I guess you guys have any questions? It's a crazy market. Everyone asks me about interest rates too all the time because I'm a mortgage broker, and every 6 weeks they make an announcement. So I guess I grudgingly do this, but I know someone's going to ask. So I don't know what they're going to do next week. I actually think it's possible that next week what they'll do is not drop rates so that in order to say that everything's okay, we're not panicking. We're not dropping rates. There's more stability here than it looks like. And then they're going to keep dropping after that. So I'd say they might do it to prove a point, because really a quarter point for 6 weeks doesn't make a difference. They'll just do it in another 6 weeks. But it will send a message of stability. So I think they might do it for that reason. Overall, I think rates are coming down for the reasons I mentioned about Ontario's economy and their housing correction and all those 1.49 mortgages folding over into 4. That's going to take a lot out of their consumer spending economy. And of course, the largest mortgage holders are young families. They're also the largest consumers. Consumer spending makes up a big portion of the GDP. So I think that they're going to keep rates low, including participating in the bond market, especially now that they have a great excuse because it's all Donald Trump's fault. So interest rates, the fixed side, I would say they would be at their natural bottom now, if it weren't for the fact that I think the government's probably going to get involved and do more quantitative easing. But we've never been in these economic times. We can't look at a time in history and go, okay, well, last time this happened, this amalgamation of things kind of converged, this is how it played out, because it's never happened before. So it's really tough to predict, but I still kind of think that, I trust the government to do the wrong thing, which is print more money, because there's just no way they'll get elected if they don't, no matter which government gets in. So that's my take on interest rates, is I think they're going to be lower even if they shouldn't be, because the government's going to want it that way. So we're going to see inflation, but they're not going to jack up interest rates, because they'll say, well, this inflation isn't caused by us printing money, it's Donald Trump's fault, is what they're going to use, but they really just want to pay off their own debt. So any other questions? What else?
Yeah, go ahead.
Yes.
I just want to say, first of all, thank you so much. Absolutely phenomenal information. I'm really grateful for that. Curious about increasing inventory. Is that primarily coming from investors selling? Are we starting to see a decrease in net immigration? Is it boomers starting to sell? What does that kind of...
It is multiple factors, slowing immigration. See, the investors selling is probably a smaller portion of it, but slowing immigration, as well as lots of mortgages renewing into higher interest rates. So when people see their new mortgage payments, they're like, maybe this is the time to sell. And now it's just like, you could probably speak to this, but it's probably the COVID wave of mortgages are now renewing at their 5-year term, right? Probably around this summer and like throughout last fall and this summer would be kind of peak renewal season. At the same time, people are uncertain as well of where prices will go. So they're like, maybe this is the peak and maybe it's time to cash out, right? Because we had a pretty good last 2 to 3 years. So people might be, some of them are selling because they think that this is the peak for now, right? So. Yeah.
Ultimately, it's like when it comes to inventory directly, it's supply and demand. It doesn't whether they buy, unless they sleep in the ether, they have to rent. Yeah. So then an investor owns that property and rents to them. So the big problem is we ramped up. Alberta's great at responsive. We're an entrepreneurial province. We have lots of very little regulation by comparison to other provinces. So when rents went up and population boomed, we reacted really quickly by building like crazy. But now we're seeing the government say, we're going to bring in 1 million people per year. And then we're going to make it 0. That doesn't make any sense. But obviously that's going to have an impact. Now I think people are still moving here, as the one chart showed, and we're going to get a higher portion of that immigration. But typically when people come, they research where they're going before they get there. Nobody just gets on a plane and be like, I don't know, where's my next flight to Canada? I'm immigrating to Canada. They've kind of planned it out. So they were planning on going to Ontario to be in one of those fake schools as a student. And now, they're kind of going through the process. So I think there's a bit of lag time in terms of the direction. And it's the same thing that happened, even in our oil downturn. Everybody was moving here, but then a year later, then they started moving to other parts of the country. But it still lasted a year just by momentum of people hey, Alberta's the place to go, and they kind of planned it out. And so I think that now it's going to be a reverse where we'll get a higher percentage of that population, but it's slowed down a lot. And then of course we ramped up building, assuming we're going to be bringing in 1 million people a year. We better build houses. And the market and a bit of speculation showed up there too. So it just creates a lot of inventory, and then all of a sudden, boom, they slammed the door on immigration, and now it's slowed down. So we're dealing with, I think, just an oversupply, and it's going to take some time to do it. Like, there are no less investors out buying properties in Sage Hill with basement suites right now, so they're building less. And that'll continue until the population growth catches up with that. But I mean, this is also, it's increasing, but it's normal. Like, this is a normal market.
Well, yeah, a lot of the builders in the new communities are slowing down, but at the same time, they have to finish what they've already committed to. They've already kind of built the roads and put in the utilities, so they have to build all these houses. So the supply is going to go up in the short term, right? Until all these houses get absorbed, and then it's going to start to stabilize over time. But it's probably going to be at least 6 months to a year before, like, the detached residential houses get kind of absorbed in the new construction side before builders decide to start pulling back, right? So until then, they're kind of essentially stuck, and they have to finish what they started. So yeah.
Go ahead.
No, sure. Go ahead.
Yeah. Okay, I'll go. First, I guess I'd like to echo that sentiment. I thought that was very good. This is my first one. You'll definitely see me again.
Oh, thank you.
Second, you mentioned, you kind of punctuated that the presentation with, I kind of expect the government to do the wrong thing, which is print money, right? So, and I think you might have rattled off some other alternatives to obviously alleviating the federal debt, right?
Yeah.
But can you just run those back for me? And like, what is the right
increasing taxes or cutting? Well, I'd be cutting services if you don't have the money to pay for something. Whether it's a legit, like, if you don't have the money to pay for social services, you can't, like, including healthcare, including the city services we get. If we don't have, like, we have to just cut back. I mean, we could probably do a lot of it with administration. I won't get into that, but if we, like, you should, like, I mean, Ralph Klein did it in late 90s, I think, or yeah, I think it was the late 90s. I don't know if most people probably weren't even alive when Ralph Klein was around. I was a teenager, and he came in and he's like, the budget's bad. It's upside down. Oil prices were at, like, record, like, all, you know, multi-generational lows. And he came in and he said, our debt's too high. And he's like, I'm cutting 5% off of everything. And he just cut 5% to every agency that you figure it out. Now, governments try to go in with a scalpel and be like, oh, we're going to be more. And it's like, but nobody would accept, like, nobody accepts that, because everyone fights for their own job. Everyone's like, even if you're screwing the taxpayer and you really do nothing all day long, you're going to fight for that because that's a pretty cushy job. So, and he's just like, sorry, this is what has to get done unless we want to go bankrupt as a province. We're cutting 5% off the budget. And he just cut it. And that was enough. And then essentially, before he ended his tenure, we'd paid off all our debt. We were zero balance. He's like, we're done. We paid off all our debt. And then he gave then he gave out Ralph bucks. He's like, yeah, here, look, just mission accomplished. Thanks for, you know, it was stupid, but also like, fair enough. He gets that, because it's a hard political thing to do, to just cut everything by 5%, but he did it, and he did so, and it might not be the right way to do it, but it just seems fair. It's palpable to people. They accepted it, they understood it was tough times, and everyone sucked it up and dealt with it. Now we're in massive deficits. The government can only think about new programs to spend money on to solve our problems. And it's like, that's the opposite direction. So that would be one of the ways to do it, is to start cutting it, but we've just built up so much debt. Like, just for Canada's debt, and this doesn't even count the provinces, but we have, like, this administration has borrowed more money than every previous prime minister, like back to Confederation. So 150 years, they built up this much debt. He doubled it in like 6 years. Part of it was COVID, but only, even his own auditor said only a third of it was actually COVID related. The rest was new programs and housing and incentives and everything else that they built. So like, the government's, not only are they not trying to keep an eye on spending, they're doing the opposite of it. Their solution is more spend. Like, yeah, we have inflation. Well, we'll print more money to help people with inflation. And it's like, but that's kind of the definition of inflation, but okay. So I just expect that is going to continue, because they have no shame in doing it, and nobody's connecting the dots, or at least it's a hard enough description that people aren't getting it. So they're getting away with it, and it's working for them, so they're going to keep doing it. Somebody to come in and do a Ralph Klein now, it's like, nobody wants to hear that. Everyone wants to hear everything's fine and they're going to get free money for something. So, and then the other one would be to raise taxes. if you like, where can you raise taxes that isn't going to have an impact? Like it's gonna, if you raise taxes on businesses, that's going to impact the economy. You raise taxes on people, it's going to affect consumption. So it should be done, in my opinion, on the I mean, there's an argument to be said about Keynes versus the politics of like, the government spending money to actually support the economy, but I think we're a ways past that, and we've stopped doing it efficiently. So that the other two arguments are, you can also default, but that's not tenable, but it often is the end result. But yeah, you either cut taxes, you increase taxes, or you cut services, or you inflate it away, because especially if you have someone else to blame for the inflation, it's just so much easier. Like, you don't have to hurt anybody, you just print money and everything gets just mushed into like, again, this time they're going to blame. They have a good villain to just like, this is why I think inflation is going to go up, because they already wanted it. They just were getting called out on it for a few years. Now they're going to have an excuse because tariffs are inflationary. That is real. So they're just going to use that to, just like COVID, they spent 3 times as much as they really needed to. They're going to do the same thing now, and it's going to create inflation. And part of it is because they have to rescue that Ontario market, that they can't let that correct. The US is better at their cap. They write off lot. They're like, hey, we took a loss. We screwed up. Write it off, start over. Everybody go bankrupt that needs to go bankrupt, and their capital markets are resilient that way. We're more like, certainly leaning more towards like Japan. They still haven't admitted defeat from the 80s. Like when they overpriced real estate, Japan has not written anything off. They brought interest rates below zero, but their economy's been stagnant because of it too. They haven't admitted loss. They just keep kind of printing money and supporting the economy by negative interest rates, where if you borrow money, they actually pay you to borrow it. Like that's the cost of the Japanese dollar. So it's yen, I guess. But it is like that's what I think we're more in line with that. It's going to be easier. And of course, our current prime minister, who looks likely to win in the polls, is definitely a subscriber to that type of economics. So we're going to see inflation. And again, anything can happen. I don't know. We could have just a world like Alberta, because we sell oil. If there is an actual world economic collapse, obviously it hurts oil prices, which could crush us. So that could also happen. But I don't think any decision we make in the next few months is going to really make a difference if that happens.
Go ahead. Yeah, you had a question.
Yeah, it was a good presentation. I think talked a good amount about the market and your experience as a mortgage broker and what you've seen in the last, call it 8 weeks as to the institution's reactions to a shifting market. How do you foresee that playing out on the lending side of things? Interest rates are only one piece, right? Availability of financing and qualification being another. Yeah. And also the role of private finance and what position it takes, in say a market specific like Alberta.
That's a good question, because it is relevant. The one thing about like, all banks are based in Toronto for the majority, like outside of ATB here, but it's a Toronto-centric world. So if Alberta's doing worse, like economically, and our prices aren't going up, so it's because Alberta's not as good as Toronto. It's like, okay, well, our incomes are better, our GDP's better, but okay. And then if Alberta is doing better, it's like, oh, well, something must be about to crash then, because there's no way Alberta could be legitimately just doing better. So it's like they always have a negative. So if they're scared about what's happening in Toronto, they cut back our guidelines almost tighter, even though our fundamentals aren't as bad. I've had arguments for years with the VPs of different banks and mortgage lenders, and they're like, well, Alberta just has higher delinquency rates. And I'm like, well, that's because our prices have been stagnant, have been flat. So if somebody misses a payment, they can't sell, and sometimes they're going backwards. If somebody buys a house and 2 years later, and they only put 5% down, and 2 years later, they lose their job, they have no cushion. They can't even sell because they're underwater on their mortgage. In Toronto, by the time they take possession of the house, they got $100,000 equity built in. So of course they're like, what kind of idiot can't work his way out of that? Like, you could do private lending, you've got enough room to list it and sell it. And I'm like now that, because even a couple of years ago I was having an argument with them, and I was like, well, now that our prices are going up, you're going to see delinquencies start going down, and you guys are going to start getting hit because your prices are flattened out, and you guys aren't used to prices that don't always rescue your poor financial decisions. And he argued, no, Alberta's just bad. People in Alberta just don't make their payments. And I'm like, no. And now the last stats that came out were I forget what the general or CMHC came out with stat, and it's basically said like 300% increase in Toronto defaults and delinquencies, and Alberta was literally immeasurable because it was like 6. Like there's like 6 people in the province that were delinquent. Like it was just immeasurable because it was so low it couldn't actually be quantified into a percentage. So, but that's the attitude of people in Toronto. It is the center of the universe. It largely is in Canada's economic kind of universe. Even though a lot of the strong economics come from Alberta, everything they do revolves around that dynamic. And of course, they all live there. They all have houses there, probably some rentals there. That's what they care about. And they're just nervous. They're always nervous because a lot of them did get burned in Fort McMurray because prices of Fort McMurray were crazy. And then that, like, they cut in half in Fort McMurray. So people have been making payments on, like, people bought houses there 20 years ago or 18 years ago and are still, 40% underwater. So there's a pretty big, like, so they did take, so all lenders remember that. It's like, okay, well, then don't lend in Fort McMurray, but what about the rest of the province? The rest of the province is Fort McMurray. But so guidelines are getting tighter. We're already seeing it. Scotia's getting really tight, which sucks because they're a really good investor lender, but they're just tightening and tightening every quarter. They have some new rule or harder on ratios, less exceptions. So we're just seeing ultimately lenders are getting tighter. I mean, they can just print money, so the availability of their actual funds is good. They don't like, as long as CMHC insure, they just love insured stuff. Because the taxpayer, like CMHC guarantees them against any loss, and then the taxpayer guarantees CMHC. So it's like, that's why they give the best rates on insured stuff, because you pay a premium that insures them against any loss. So they can lend as crazy as they want, as long as they fit CMHC's guidelines, knowing that they're covered. Which is essentially why I think part of the reason why Toronto got so excessive. There's no way they would have allowed Toronto to get to where it was if they didn't know that they were ultimately backed by CMHC. So so definitely going to impact our market. But I don't think qualifying's getting tighter, but I don't think that's going to be a major issue for us. Our affordability is still so much better than the rest of the country. I don't think that's going to be a restriction in any way that it really shouldn't be. It does directly affect investors a little bit more, and that is getting tighter. So it sucks for me as a mortgage broker that works like at least 50% of my business is investors. So it does actually impact me a little bit more, and the people in this room it will impact a little bit. But in terms of overall impact on the market, I don't think it's going to be that big of a deal. That's a long answer. I feel like I'm talking in circles, but that's because there's so many different things at play right now. It's hard to get an answer. I know you had another question a minute ago.
Yeah, I was just curious. So I'm new to Calgary, so I don't quite know all the dynamics here, but I know that there are 3 office conversions that they're doing to residential. My understanding is that should come onto the market kind of around the same time that you're expecting things to level off in terms of inventory. So I know we're talking suburbs versus downtown, increase in student visas, there's so many factors, but do you think that's something that could significantly impact the market, or is it
I saw the stats recently on it, and it was like hundreds of units, and it's like we have tens of thousands of available units, and it's hundreds of units that'll be available. It's a good program to take old office buildings and move them. There's certainly some limitations on how much they can do that. You need a small enough building, like a footprint that's small enough. So a lot of the newer, like it has to be small enough because otherwise the middle, like how do you build, otherwise they would all be like long apartments going out because you need window access, right? So it's very challenging for them to actually.
Yeah, I don't think like the office to residential conversions are going to be a very, very small proportion of actually adding to the housing supply. So I don't even think it's significant enough to count in the numbers. So
yeah, So it's a really good question because I wonder that even myself. Like, is this going to impact? But then when you see the restrictive capacity, not even the government's really supporting it, the city, the province are all supporting it. It's just there's not enough buildings that actually fit to be able to actually build condos out of that wouldn't be 10 feet wide and 100 feet long. So it's just not going to make it.
What will add to the downtown supply is all the towers that are going up.
Yes.
Like, 3 months, I think roughly 3 months ago, I was looking at how many towers are going up, and 16 residential towers under construction right now, with an estimated 3 to 5 year out completion timeline, right? So, and those are like from the hundreds to thousands of units each, right?
Yeah.
that's what's going to add to the downtown glut. So
Yeah. And
on
I
top
mean,
of that, all the office vacancy as well.
yeah, we're at 30% office vacancy.
Yeah.
There's still more vacant office space in Calgary than there is total office space in Vancouver.
Yeah.
But that is actually a good thing for residential real estate investors, because when you look, if you own the REIT that owns that sucks. But for us, it's like it makes any company, like that's why we've had such a massive increase in like tech. Like Calgary, we had the right workforce for it. Like all of our oil and gas statisticians were just turned into big data specialists. They already had math degrees, they already knew how to code. It was a really easy transition. So we actually had a workforce that weren't directly trained to be in tech, but were easily converted into tech. But one of the reasons people like is a tech company can hire or expand here. And this is where, like from India, where they're like, hey, we're going to expand into North America. They're starting to end up in Calgary. And we actually had somebody here who's from South India in the tech industry. And he's like, oh yeah, Calgary is now, like no one had heard of Calgary 3 years ago. Now everybody's talking about Calgary. And I was like, what? And he's like, and I was like, most places, like everyone knows Toronto, Vancouver, maybe Montreal, but nobody knows where Calgary is. You could ask 100 people in Texas, and unless they happen to be hockey fans, they wouldn't know where Calgary is, right? Like it's very, very few people. As you leave North America, very few people are going to know. But in the tech world in India, Calgary is a known place. So you can rent office space for a third of what you can in Vancouver, Toronto. Not only today, but when your renewals are coming up, you know that you got 30% vacancy. It's going to take decades to actually fill that up to the point where it's compressing and causing prices to go up. So you've got a long window, you've got a long runway of like 20 years of cheap office space by comparison within North America. Then you also know that your employees could go buy, instead of spending $800,000 on a one-bedroom condo, they can go buy an $800,000 single-family house with a yard, get married, have a couple kids, put them in school, and now if they get a job offer to go to Boston, it doesn't matter whether it sounds cool or not, they can't go, they got kids here at school, they're married. But if they're stuck in an office, like at an $800,000 condo in Vancouver or Toronto, they're like, yeah, whatever, what's holding me here? So they like the stability of people with families, and the affordability of Calgary allows people to build families here. So there's a handful of things that office space actually is ultimately good for us.
Well, and just to add to that point, or to that, we still haven't hit the low point on the office market. So buildings were selling at what people thought were all-time lows of $80 a square foot, but Hanover Place on 6th Avenue and Center Street just sold for $37 a square foot. So someone could rent that out for $4 per square foot in cash. So it's ridiculously low.
Yeah, which again sucks if you're the REIT that owns that, right? Or had to just sell that. But because when you started building that in 2011, or you bought that in 2011 when like the money, oil prices were booming and everything was going crazy and expenses were off the charts, you thought you were going to make a lot of money and you didn't. So, but again, for residential real estate, it actually creates a really strong environment for us to build businesses here, along with a government that's friendly, low regulation. So ultimately it's good. I think we'll wrap it up. We're going to be here, so you can still obviously ask us questions. We're just wrapping up this part of it, but it is really a meetup. We just do a presentation at the beginning. So just if you have a white chair.
We'll switch to the networking portion.
Yeah.